Well, I think whether it's fixed or floating, any type of capital, the question really starts with what is your business plan for the asset? I mean, anything that you have, whether you're buying something that is already built and cash flowing, or you're intending to build something from scratch, or you're going to buy something and fix it up, there is a business plan. You may not call it a business plan. We don't often in real estate call it, but it's a business plan. And that business plan anticipates the amount of money you're going to need, not just to buy, but any needs you might have for funding while you hold that asset, that project. And your business plan also anticipates at some point you're going to get out of that, you're going to sell it, or somehow that investment is going to end or go into another phase. So the question about fixed versus floating is really a question about what is the right capital and what is the right debt product to match your business plan. So now, for instance, if you're buying an existing asset, it's stable, it's full, it's going to cash flow. You're not going to really create any great additional value. It's what we would call a coupon clipper. And you're going to hold it at least, say, 5 years. It's a fixed rate product. And why is it a fixed rate product? Because fixed rate products, first of all, have much more duration. They are not just fixed in rate, they're generally almost always fixed in terms of the amount of proceeds. So they are very much product that fits best for when you buy something and you have very predictable cash flow from the time that you own it through your ownership until the exit. That kind of fixed rate debt matches best with that kind of profile. But if you're buying something where, maybe cash flow is a little bit low, you see an opportunity to create more cash flow. Maybe it's an older property and you're going to go and renovate units. Maybe there's some deferred maintenance, needs some new roof, but there's an actual business plan in which you anticipate doing work, investing some additional money post closing, and creating value. Those tend to match up with a floating rate product. And the reason for that is typically you're starting out with cash flows that are not maximized, so they don't support a big fixed rate loan. You need to put money in during the plan, so you need flexibility you get with floating rate. And you need usually, once you create the value, you're thinking about selling. So you have a shorter hold period. And again, the floating rate tends to be shorter term. So you have more flexibility and a better match in floating rate, where you are buying an asset where there's a business plan and changing, increasing in cash flows, increasing, values.